Let me show you 5 investors. One put all their money in equity, one in gold, one in silver, one in debt, and one built a mixed portfolio. Every year, these 5 have very different emotions. One makes the highest return, one goes through the biggest fall, and one sleeps peacefully. But which portfolio actually wins, and not just this year but long term? Let's head to the board and let's solve this mystery. But before we start, here's a quick note. This video is brought to you by the Angel One research team. We are NISM registered research analysts, and this is not investment advice. It's purely to help you understand asset behavior so that you can take informed decisions for your own portfolio. Now if we look at this year's leaderboard, we know who took the lead. Investor number 3, the 100% silver investor. This one had the wildest ride. This year, silver is up more than 100%. On paper, it looks like this investor absolutely crushed it. But, only looking at 1 year can be misleading. Rewind just a bit. Between 2021 and 22, silver went through a bone-crushing 40% drawdown in less than a year. Now let's look at the equity-only investor. Till October 24, markets felt unstoppable. Every dip was a buying opportunity. Every chart looked like a staircase going up. Fast forward to now. Returns have cooled off, momentum has slowed, and suddenly the wait begins again. Same asset, completely different motions. So who's winning actually? Let me show you something. This right here is the asset class leaderboard year by year. Every color represents one of the investors from our story. Every column is a year. And if you look closely, the top performer keeps changing. Now if we talk about the silver investor, the superstar of 2025, look at 2013 to 2015, 3 years of consistent losses. And then, just the next year, it emerges as the biggest winner. And just the next year, it falls back to the lowest. Similarly, look at the equity investor. 2016, not a great year. But suddenly, the very next year, up to 37%. And then the next 2 years are back at the lowest. Do you see it? This year's winner does not indicate next year's winner. Sorry, Investor 3. Now let's zoom out from yearly returns and look at something far more honest. 5-year rolling returns. Think of rolling returns like a CCTV camera. Instead of one photo, it records every possible 5-year journey an investor could have taken. It's the most honest way to understand how an asset behaves across good and bad cycles, global shocks, domestic slowdowns, inflation spikes, liquidity waves, everything. And here's what the CCTV captured. Indian equities across 2007 to 2025 delivered outstanding long-term returns close to 26% on average. But even equity had worst 5-year period of just 1.2%. Yes, a full 5 years where you basically earned nothing. Now look at the drawdowns. This is where reality hits. If we look at the last 10 years, during COVID, Nifty fell nearly 29% within weeks. No time to think, no time to stay calm. Many investors panicked, stopped SIPs or sold at the bottom. And if you think gold was peaceful, yes, gold delivered peak 5-year returns of 27.9%, but it also fell nearly 18%. Silver, it tested patience. 5-year returns went as high as 29%, but drawdowns touched 38%. And debt never fell drastically, but its max 5-year return was only 9.5%. So here's the truth. Each asset looks amazing in some years and extremely stressful in others. No single asset performed consistently across all market environments. This is why smart investing isn't about chasing what's hot, but about building portfolio that can survive cold phases too. Asset classes rotate. Equities lead, then correct. Gold sleeps, then shines. Debt feels boring until it suddenly matters most. Even global markets take turns. So, the real challenge is not chasing returns, but surviving risk. And as the classic Brinson-Hood-Behaviour study showed, asset allocation alone explains 90% of long-term portfolio outcomes. By the way, Brinson, Hood and Behaviour were the researchers who changed investing forever by their groundbreaking research in 1986. That is why we are going to talk about that one powerful instrument, which is the multi-asset fund that helps you do just that. And this brings us to that one powerful instrument, which is the multi-asset fund that helps you do just that. Now you know which investor slept peacefully. But trust me, the story has just started. Let's look back at our 4 main assets again: equity, debt, gold and silver. Now imagine these 4 in one room. They don't react to news the same way, they don't move in the same direction, they don't peak and crash together. And that is the foundation of risk management. Diversification isn't just owning many things, it's owning things that don't behave the same. Watch what happens. Equity carries the highest growth potential but can also fall sharply during stress periods. But gold often rises at the same time. Debt mostly moves in its slow but stable lane. Silver, while more volatile, sometimes follows gold. The correlation matrix makes this relationship clear. It shows how different investment options behave with respect to each other. Equity and gold show negative correlation. Debt remains weakly correlated with risk assets. Silver behaves differently from both equity and debt but strengthens diversification when combined with gold. When you put these together, your portfolio stops depending on one winner and starts benefiting from multiple behaviors. Please understand, and this is very important, your portfolio becomes safer not because you added more assets, but because you added assets that react differently. This is exactly what a multi-asset portfolio is built to do. Not to predict the next winner, but to survive the losers. Now let's bring back the hero of our story, Investor 5. This is how their simulated multi-asset portfolio looks like. 30% equity, 35% arbitrage, 15% gold, 10% silver, 10% debt. Now here are the returns. Max 5-year rolling returns 19.4%, minimum return 5%, negative periods 0. Yes, 0. This is the magic of diversification, not theoretical but visible in front of us. But it is the distribution that tells a powerful story. Look at equities. They gave more than 15% returns in 38% of all 5-year windows but also had negative windows. Silver, nearly 29% negative windows. Imagine holding that for 5 years. Gold had 10% negative windows. Debt was safe but barely crossed 10% returns. Now compare that with the mixed portfolio. 0% negative outcomes. 80% of the times returns were between 0 and 15%. Nearly 30% of periods delivered double-digit returns, and all this without going through massive crashes. This is stability you can actually live with. But now comes the next big question. Okay, how do I choose the right multi-asset fund? Let's walk through this quickly. Head to Rupee West, then Tools, and then you'll find MF Screener. Now here's what you check. AUM, expense ratio, exit load, 5-year and 10-year returns, Sharpe ratio and standard deviation. Now standard deviation is very important here because multi-asset funds are supposed to reduce volatility. Lower deviation is equal to smoother returns. Now once you apply these filters, you will get a clean shortlist. Quant multi-asset allocation fund, great returns, 24.51%. But higher volatility, around 11.33%. Then comes ICICI Prudential Multi-Asset Fund managed by Shankaran Naran, one of India's most respected investing minds. And the fund reflects that experience. Strong long-term returns, lower volatility, and a philosophy built exactly for cycle management. Edelweiss's aggressive hybrid fund has respectable returns but lags on long-term consistency. Now here's the catch. Multi-asset strategies need a long runway to judge behavior across cycles. That's why out of the top 5 screener results, we narrow down to the 3 funds with sufficient history for meaningful rolling return analysis. ICICI Pru Multi-Asset Fund, SBI Multi-Asset Allocation Fund and UTI Multi-Asset Allocation Fund. So what do we do next? We go to Tools, then MF Rolling Returns, and this is where clarity hits. ICICI Pru 19.25% average, max 34.35 and 0 negative periods. SBI Multi-Asset extremely stable in the 10 to 20% range, and UTI Multi-Asset balanced profile, again 0 negative windows. These are the funds built to handle cycles, not chase trends. So now, after looking at the leaderboard, the rolling returns, the drawdowns, the correlations and the real behavior of each asset class, you finally know the truth. There is no best asset class, there is only the best combination. So which investor were you so far? 1, 2, 3, 4 or 5? And which one do you want to become now? Tell us in the comments. And if you learned something new today, then do like the video and subscribe to our channel. See you in the next one. Even gold markets take. I said gold. Shit. And as the classic Brinson Hood Brinson Hood Beboer. Not to predict the. By their ground. Got too excited.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.